Good morning and good afternoon, everyone, and a very warm welcome. Thank you very much for joining us. Today is something of a milestone. We're here to mark the launch of a new international standard, ISO 32212, on net zero transition planning for financial institutions. And ISO, so just that we're all starting from the same place, is the International Organization for Standardization, the global body that national standards bodies around the world belong to, and I'll say more about that in a moment. The titles of today's session is From Commitment to Execution, and that is obviously a deliberate choice. Because I'm sure you recognize that over the past few years, there has been no shortage of ambition across the financial sector when it comes to the climate transition. The harder question is how you actually put that ambition into practice, consistently and credibly. And that's what the next 90 minutes are really about. Well, let me start with a few quick introductions and some housekeeping. My name is Daan van der Bekker, and I'm the head of sustainability at BSI, the British Standards Institution. And for those who haven't come across us, BSI is the UK's national standards body, and I'll explain in a moment exactly what that means. And I spent most of my career on the practical side of sustainability. And one of the things that always interested me is the gap between intention and implementation, between what organizations say they'll do and what actually changes on the ground. Standards, if done well, are one of the most powerful tools we have for closing that gap. And that's really what brings us all here today. So I'm delighted to be hosting, and we have an excellent group of speakers lined up for you. Now, before we get going, a few quick practical points. This is a listen-only session, so your microphone will stay off. But please do use the reaction buttons at the bottom left if you like to respond to anything you hear. If you have questions, and I obviously really hope you have these, please submit them using the question button at the top right of your screen. And if you like a closer look at any slide, you can zoom in and you can take a screenshot using the icons to the right. Also, keep an eye on the chat box at the top right, where we'll share some useful links as we go. And in the unlikely case you hit any technical issues, please flag them through that same question box, and our team here on the ground will help you. And then at the very end, once you've completed the short feedback survey, we'll send you a link to the recording. And there's also a QR code on screen if you like to see what else BSI is coming up. Here's how the next 90 minutes will run. I will begin with a short overview of BSI and ISO to put some things in context and how the various sustainable finance standards fit together. After that, I'll hand over to Mark Manning. Mark convened our international working group that wrote ISO 32212, and he is, amongst others, a visiting senior fellow at the London School of Economics. And Mark would talk about the role that the financial sector plays in enabling the climate transition. Then Paul Pritchard, who led the technical development of the standard, will take us inside ISO 32212 itself. And from there, we move into the heart of the session, a panel discussion, and hopefully your questions with Hannah Kool, Manfred Gill, and Dr. Karsten Sielke. And Mark will introduce them once we're there. And then I will close us out at the end. So let's begin. Let me start with a little bit of context. Who we are, who ISO is, and why standards matter in this space at all. And I will keep this very brief, but I do think it's worth spending a few minutes on it, because a lot of people use the word ISO and standard without necessarily knowing what structure, what global structure sits behind them. And it really does help to understand where this fits. So let me start with an introduction to BSI. For those less familiar with us, BSI is the UK's national standards body. We are independent of government and industry, but we operate under a public interest mandate. And we've been doing this for 125 years. So what we do is we help to convene global stakeholders to create voluntary standards that promote best practice, that support the delivery of government policy, but most importantly, that build trust. And in our function as the national standards body, we publish some 3,500 standards each year. And all those standards are market-led. We do not write them ourselves. We don't write standards. The standards are built through consensus, through consultation, by bringing the relevant experts and the stakeholders around the table to agree how or what good practice looks like, and then we put that out for public comment. The result of the process is voluntary guidance, so nobody is forced to use it, but that it's guidance that organizations choose to adopt because it helps them to demonstrate good practice, and it gives their clients and regulators real assurance. So we operate in the national interest, but clearly with global reach and impact. And I think it's key to understand that we are impartial, apolitical, and we are independent. We're not government, we're not a regulator. Now, as the UK's national standards body, we also represent all UK's economic and social interests across all European and international standards organizations, including ISO. Next, please. Thank you. So, if BSI is the UK's national standards body, then ISO is the global one, or more precisely, it's a network that connects all the national standards bodies together. And as you can see from the map, its reach is really worldwide. There's 177 jurisdictions at the moment. So ISO really is the world's largest developer of international standards and represents the global standards benchmark. And there are three characteristics of ISO standards that I do like to share with you. First of all, ISO standards provide global legitimacy and recognition. They're internationally recognized, used across more than 170 jurisdictions, and they're trusted by both developed and emerging markets. Secondly, ISO standards are inclusive, they are consensus-based. They're built through a balanced global process, and that process ensures equal input from different regions, from different sectors, and from different stakeholder groups, making sure that both developing and emerging markets have an equal voice. We're a bit like the United Nations of standards. And thirdly, ISO standards are adopted in the real economy. They're not just theory, they're not theoretical. They're widely adopted across industries. And the example I always use is ISO 9001 around quality management systems. Over 1 million certificates have been issued across more than 170 countries, which make this the most widely adopted standard in the world. And that real economy connection also ensures interoperability. It reduces fragmentation across international markets. So this global legitimacy and the way ISO standards are made are exactly what we think is needed to make our climate transition standards credible and usable everywhere. Now, next slide. This is probably the most important slide in my section, because it really answers the question that I'm obviously asked a lot. Do we really need another standard? Because there's already a great deal out there on transition planning. So let me be clear about what an ISO standard adds to an already crowded landscape. The first is that ISO standards embed established good practice into the global system. We do not come in ahead of regulators or policymakers or initiatives like G-Events or the Transition Plan Task Force. We come in behind them. We take the good thinking that's already emerged and turn that into something practical, internationally accepted, and crucially, certifiable. The second thing, and I really want to stress this, is that ISO standards are designed to complement and not to duplicate. But this standard, of which you will hear more in a second, is built to sit alongside existing regulation, supervisory expectations, disclosure rules, and market guidance, and not to compete with them or to replace them. So if you're already working with those frameworks, this standard is designed to work with them, not against them. And the third one is really the theme of today. Standards bridge the gap from ambition to implementation. A commitment, a disclosure, it tells the world what you intend to do. A standard helps you actually do it by giving you structure, consistency, and repeatability, so that transition planning becomes a real part of your day-to-day governance and decision-making, rather than a one-off exercise. And I mentioned the word certifiable. So what that means is simply that an independent third party can come in and confirm that you are doing what the standard sets out. And that's That's what turns a good intention in something your clients and your investors and your regulators can actually trust. Now, that's a bit of context around BSI and ISO. And with that in place, I'm delighted to hand over to Mark Manning.
Wonderful. Thank you very much indeed, Dan. It's excellent to be with you all today. Really looking forward to the discussions that we're going to have over the next hour and a bit. So with that introduction from Dan, I just want to say a few words about why it's important to introduce international standards specifically for financial institutions in relation to their role in the transition. So my starting point is the acknowledgement that fundamentally there is no business without finance. Sitting at the centre of the economic system, financial institutions' lending, investment and insurance decisions ultimately determine business strategy. They govern how effectively firms' clients and their investees are able to respond to the economic, scientific and policy signals and position themselves for future success. So financial institutions can play a critical enabling role in supporting their clients and investees to manage risk and capture opportunities associated with the global transition to a low emissions and climate resilient economy. Given that, the theory of change underpinning this standard, ISO's standard on net zero transition planning for financial institutions, is that by establishing robust, credible processes for transition planning as a strategic exercise as part of wider business planning, a financial institution will protect and enhance its own long-term value and that of its clients and beneficiaries. So what does this look like in practice? Well, as a starting point, firms can assess forward-looking climate-related risks and opportunities and use this information to develop and maintain transition planning objectives and targets, and to establish robust policies and processes to integrate these objectives and targets into their financing strategies. For instance, they can set policies and decision criteria for their lending or their investment activity or in their insurance activities that reflect those objectives and targets. And they can analyse their clients and their investees' decarbonisation and climate adaptation strategies to inform their priorities for client engagement. Now, a fundamental recognition in the development of this standard is that climate-related risks can be viewed as both exogenous and endogenous to the financial system. That is, financial institutions are not only exposed to proximate climate-related financial risks, which are already influencing asset values today and will continue to do so, but they can also contribute to future system-wide risks, such as those that could arise from a disorderly transition or that could arise from extreme warming scenarios that exacerbate physical climate risks. So effective transition planning within financial institutions can therefore be expected to support greater resilience at both an institution and at a system level, while also capturing commercial opportunities associated with mobilising the capital needed to advance the goals of the Paris Agreement. Another fundamental recognition, though, is that we need to understand that financial institutions play an enabling as opposed to a controlling role in the transition. The principal decarbonisation and adaptation efforts will take place under the control of real economy actors and subject to supportive policy and wider enabling environments. So identification of the interconnections and the external dependencies that will ultimately impact the effectiveness of a financial institution's transition plan represents an important ongoing element of the transition planning process. And the standard emphasises this wider system perspective. It gives prominence to engagement with policymakers, regulators, and other ecosystem actors who collectively establish the enabling environment in which those institutions operate. So that's a really important framing point for the standard itself. So I hope that's given you a bit of an idea of why ISO decided to develop a standard in this area. This standard will sit alongside a wider whole of economy net zero standard, which you may have seen was issued for consultation just last week during London Climate Action Week. So together, these standards will hopefully create a common language and a set of commonly understood policies and processes and conditioning points for the whole of economy transition. Now, to dig into all of this a little bit more, I'm going to hand over to my colleague Paul Pritchard, who, as Dan said, was the technical author of the standard working with the International Working Group. And Paul will walk through the content of ISO 32212. Over to you, Paul.
Great. Thanks very much, Mark. And hello, everyone. As Mark said, I'll spend a few minutes going into some more detail around the standard, the content of the standard, and then hand back to Mark for like the real core bit, which is your own questions and a distinguished panel discussion. Okay, so if we move on to the next slide, first of all about the objectives and some of the key attributes around the standard. So for those of you familiar with ISO standards, there are certain language that's used and certain phrases that are used, and within this standard that also applies. So the standard itself specifies requirements, and those are things that need to be met in order to achieve certification. The standard itself is written to be capable of being certified. So an organization following it can get third-party certification, but it can use it as guidance as well. And so there are lots of additional recommendations beyond the requirements, and also a lot of notes tapping into the kind of existing materials that are out there that Mark and Dan have already highlighted. And the wording that we use and the sort of positioning of the standard is intended to be consistent with the Paris Agreement. So the language that we're using and the approach that we're taking, the common but differentiated approach, is intended to align with the Paris Agreement, hence about the institution's response to the transition to global net zero and a climate resilient economy. So that's wording directly taken from the agreement. In terms of attributes, it's already, I think Dan already mentioned this. This is very much about internal systems and processes. And in that sense, it's complementary to a lot of the existing frameworks that are out there that are very focused on disclosure. Obviously, there's a need within the market for information that's altogether appropriate for regulators and markets and investors and so on. So this standard actually focuses on the processes within the institution, of which one of the outputs would be disclosures. So it's transition planning rather than transition plans, but a transition plan could be an output of the system. We've already mentioned that it's compatible with and essentially consolidates a lot of the existing great material that's out there. And we've highlighted a few there: GPANS, TPT, IFRS, and quite a number of others as well. So I think a lot of you will see a lot in there that's already familiar. The other thing is, and this came out very strongly early in the working group, was that we shouldn't overstate the capabilities of the finance sector. That, as Mark said, the finance sector is really about a critical but an enabling role, and it's actually the decarbonisation and adaptation that takes place in the real economy. So there are lots of dependencies associated with transition planning for financial institutions, and hopefully those are properly acknowledged within the standard. That's the aim. It's designed for global applicability. So again, echoing in the Paris Agreement, the common but differentiated responsibilities, and reflecting jurisdictional priorities, or capable of reflecting jurisdictional priorities and requirements, including legal requirements as well, and is designed to be applicable across the whole of the financial sector. So banks, insurers, investors, and some of the newer financial institutions that have appeared recently as well. One of the things that we discussed quite a bit early on was the actual aim of the standard, and this is very much about scaling of transition finance, essentially, and an interoperability linked to that. So scaling transition finance globally. And I think one of the elements that we see as significant in that context is certainly integration within existing financing decision-making, but also access to the ISO assurance infrastructure, so that the standard is capable of being independently certified to say, yes, we have these elements in place consistent with the standard, and it's operating as intended. So an additional independent assurance element with the ecosystem, the ISO international global ecosystem already in place. And as Mark said, it references and complements existing and upcoming ISO standards. A lot of the 14,000 series are out there that are relevant to this. 14,001 environmental management systems, the GHG accounting ones, and of course, as Mark said, the upcoming real economy net zero standard 14,060. So, and I would also mention there as well the work that ISO is doing with the GHG protocol to harmonise how things like Scope 3 emissions are categorised and considered. Okay, so those are some of the key attributes. If we go on to the next slide, this is the one and only diagram in the standard, and I think it's been quite well received, partly because it emphasizes the dynamic and iterative nature of transition planning. This isn't a one-off exercise. It's actually explicitly acknowledged that there's going to be a requirement to review what's happening and update what's happening. And that's from the impacts, the policy framework that's in place, the operation of the processes, the targets and the objectives that within the system. All of that is kind of a loop. And I think for people who are familiar with TPT, for instance, it looks very much like the loop there. For those of you from an ISO background, it looks very similar to the kind of ISO plan, do, check, act management system approach. So I quickly go through some of the elements here. There's no requirement to literally follow it in the sequence that we're going. It just feels like a logical sequence. That really starts in the sort of top right with looking at the current position of the organization. So that's the nature of the business, the geographies they operate in, the sorts of products and services that they're involved with, and the sorts of climate-related risks, impacts, and opportunities associated with that. Moving from that, really taking a forward look using, and emissions inventory would be an element within there. And from that, using scenario analysis to have a forward look over the potential risks and impacts and opportunities that the organization faces plausibly in terms of the transition. So that would be using things like the relevant sector pathways or certainly the national pathways that would be appropriate to the organization. And from that, identifying transition levers, the sorts of ways that the financial organization, the individual financial organization, can actually achieve real economy impact. And from those levers, so the prioritized levers, developing a series of objectives and targets. And part of that will be to ensure that those activities are integrated into both the financing processes themselves, so things like the due diligence or credit risk or underwriting. So there'll be policies around those elements, but also importantly around the engagement activities. And that will be engagement with counterparties, but also wider engagement with NGOs, with peers in the sector, and potentially with policymakers as well, where there are particular problems or roadblocks or whatever else. There is an element of communication disclosure in there. What's in there is intended to complement other frameworks, particularly things like the upcoming IFRS requirements, but it does require something, even if an institution isn't subject to anything. It would still have to have some disclosure around the progress of the transition planning within the organisation, and also some appropriate internal communication, so people who are involved with the transition planning processes actually understood their role within that whole organisation approach. The last couple of bits, and some of these are probably less familiar to those of you from a financial background, around the performance review and update elements. This is very much geared to the internal assurance and leading to the certification. So there's a requirement for periodic internal audits or reviews to ensure that the processes are working as intended, and formally acknowledge things like non-conformances and corrective actions to address those. And I think one of the important elements is a top-level management review. And this is where the senior body within the organisation actually looks at how the transition plan processes are operating and makes appropriate changes as well. There's also consideration of data quality. We're recognising that currently data isn't necessarily of the quality that people would wish. So there is a requirement to assess data quality as well. Final thing before I hand back to Mark is, right in the centre of it is governance, and I think this is something that's common to most, if not all, frameworks. A requirement for senior level ownership of the planning system, and ensuring that it's adequately resourced as well, and that the documents pertaining to the operational system are also retained and accessible, and that's also to facilitate the external insurance. So apologies if I raced through that very quickly, but hopefully that gives a flavour of the main elements of the system. And with that, I'm going to hand back to Mark to introduce the panel session. So thank you very much.
Wonderful. Thanks so much, Paul. So I hope that's given everybody a really good foundation for the discussion to come. And for that discussion, I'm delighted to be joined by three fantastic panelists. So let me introduce each of them to you. So we have Manveer Gill. Manveer is Head of Sustainable Business at CDP, and he's been with CDP for the last 6 years or so. And Manveer was a really important contributor to the working group that developed ISO 32212. So fantastic to have his perspectives on the panel today. And then I'd like to introduce Hannah Kuhl. So Hannah is Senior Executive and Board Level Advisor with Horizon Leadership Consulting. And with Horizon, she has a focus on helping companies navigate the transition. Hannah is probably known to many of you in the climate and sustainability community. She has a number of other advisory roles across the ecosystem, including with initiatives such as Rewired Earth and Cronean. And Hannah was formerly COO with Bankers for Net Zero, and before that held senior roles with KPMG and PwC. And last but not least, Dr. Carsten Siegler. So Carsten was another important contributor to ISO 32212. Carsten is founder and managing partner of Siegler Research Consult, which helps banks and insurers navigate sustainability and financial reporting regulations. He also has advisory roles with EFRAG and with Germany's Federal Environment Agency. And prior to this, Carsten held senior roles in investment banking with Societe Generale and Bear Stearns, where he analysed and advised insurance companies. So we've got some fantastic experience on the panel today. Welcome to you all. Thank you all so much for taking the time to join us. So I'm going to ask each of you for some opening remarks just to kick us off. And perhaps I could start with you, Manvir. Perhaps you could kick us off with a bit of context on current transition planning practice among financial institutions based on the data that you collect at CDP, and give us a bit of a sense of how that transition planning practice is underpinning these institutions' engagement in transition finance. Over to you. Thank you very much.
Great. Thanks, Mark, for the introduction. Good to be with you all. On to the next slide, or even 2 slides on, please. And so just a brief introduction to CDP for those of you that aren't aware. We collect data from over 20,000 companies, financial institutions, city states and regions on behalf of a range of multinationals, investors and banks globally. And that gives us a really rich data set to understand what the practice currently looks like across the financial sector. We've mapped a variety of different frameworks around transition plans over the last few years, and that's informed the questionnaire that we send out to financial institutions. So on to the next slide for just a bit of a flavor for what we see. I didn't want to go into too much detail on the different elements of transition planning. I think we've heard a little bit about that in terms of the standard. And so here, what we have is just a select set of indicators that cut across some of the elements of credible transition planning for the financial sector. And really, what I wanted to show you is that we've got a real range of uptake of certain elements of transition planning. So some of the really TCFD underpinned activities, the likes of having an understanding of climate-related risks and opportunities and using that to inform strategy development, being underpinned by scenario analysis, that's actually pretty healthy. We're looking at 4/5 of the 480 financial institutions that disclosed to CDP in 2025, representing over 100 trillion in assets. They are telling us that this is something they're looking at. And I think it speaks to the value of some of those efforts over the last few years to mainstream the likes of TCFD, now ISSB disclosures. And so speaking to that interoperability piece that you've mentioned previously, and how the ISO standard really builds on existing frameworks. I think similarly, we see that there is quite broad uptake of provision of climate-related products and services. You know, that's including the likes of frameworks that are based internally within a financial institution, but also perhaps based on ICMA-related frameworks, those provided by the loan market associations. And we also see a large proportion engaging with clients and investees, over 80% of both of those indicators. And so this kind of paints quite a positive picture, right? It kind of it suggests that maybe we're there, or we're almost there. And I think that the last indicator I'll speak to is just around portfolio climate targets. There's been a lot of healthy debate about the current state of portfolio target setting. What does credible target setting look like? What does that actually mean in practice? We see that the majority of the financial institutions disclosing to us have a target at present, and that really ranges from sector-specific targets, looking at some high coverage sectoral decarbonisation approaches, to portfolio emissions intensity targets, and then a range of your classic financed emissions targets, temperature scores, and the like. And so I think what we're getting to is that ultimately we know finance isn't scaling at the rate that it needs to if we want to be Paris aligned, and we know that there's across all of these different frameworks a real opportunity to demonstrate credibility for financial institutions. And so I think what we see as a real opportunity for the ISO standard in particular is to cut across that and to provide that internationally recognized framework to support efforts where they're being undertaken. And onto my next slide, please. I think I've spoken a lot to some of the different indicators of transition planning, but let's remember why we're doing all of this. It's really about implementing change through the real economy, and this links through from various transition finance frameworks that we see in the ecosystem as well. So we see that there is both a requirement to look at counterparty level data and considerations within various transition planning frameworks for the financial sector, but also for transition finance frameworks set by the likes of the Transition Finance Council in the UK, by the Loan Market Association and ICMA in relation to entity level or general purpose instruments. And so I think it's good to see that there is a bit of convergence in the increased use of this real economy data that's being generated. Here we see that 60% of counterparty transition plans are, or 60% of financial institutions are considering counterparty transition plans in their due diligence, for instance. And I think that it speaks to this broader point of how financial sector transition planning doesn't necessarily operate in isolation. It's one key pillar alongside all of the efforts in the real economy, not just to generate data, but actually to enable the real economy to decarbonize. And that basis is going to be what determines whether or not we're able to scale transition finance at the rate that we'd like. So I'll pause here. I won't go into too many other stats. At CDP, we have a lot of data, and we do love to surface some numbers.
Thank you so much, Manveer. This is brilliant. This really gives us a nice a nice foundation for the discussion. And as you say, there are some evidence points there that things are already moving, that this is already coming into play. You touched on a little bit the fact that the standard can sort of help embed credibility. I wonder if there's anything more you can say about how the standard can sort of help us build on these foundations.
Yeah, absolutely. I think that whilst we see that there is maybe uptake of individual indicators, only a small minority of financial institutions are actually taking up kind of say the majority of indicators, or even all of them, of what we see constitute as a credible transition plan. And so by providing an internationally recognized framework, something that's aligned with TPT and some of the other frameworks that the TPT also built on, there's a real opportunity here for ISO to give institutions that common reference point for plan quality. That can also help supervisors and investors compare plans more meaningfully, especially across jurisdictions where we know there can sometimes be fragmentation.
Brilliant, really helpful. Thanks very much indeed, Manveer. Perhaps I can turn to you, Hannah. So, I mean, does that picture resonate with you? You obviously had a lot of engagement with banks in particular across the system in your work with Bankers for Net Zero. What were you picking up there in terms of the biggest challenges and constraints in transition planning, and where some additional guidance that brings a lot of the existing tools together into that common reference point that Manveer just mentioned might be helpful?
Well, just understanding where to focus effort is such an important part of why standards like these are so critical. You know, the reason that the banks that I worked with joined the Bankers for Net Zero community in the first place was, one, obviously recognition of the need and the ambition, but importantly, the ability to talk to peers and understand what they were doing in this space, and to understand how they were tackling, whether it is reporting and mandatory standards, as well as developing and delivering transition strategies for their organization. Now, as soon as you start to bring together guidance like this, you see the maturity curve rapidly change, right? You know, there is this kind of slow build in the market. And then as you start to bring together what is a consistent, repeatable, best practiced aligned version of how to adopt transition plans, how to build strategy, you start to see rapid maturity in the market, which I think is brilliant. But there are still, if you like to think about, you know, the interplays in the market as well. Now, in the UK, the banks that I work with will also be focused on the mandatory elements that are creeping in, including recent PRA guidance released in December, so most notably SS 525, which really does focus on enhancing climate-related risk assessments and how to manage that risk. Now, if you think about it, you can only manage risk by understanding your portfolios and recognizing how to transition them. That makes this guidance even more important, because understanding where to get data from, whether that's outside-in data or whether that's customer data, recognizing the quality of that data, how to assess portfolios and understand the risk, both physical and transition, is one thing, but actually being able to manage that risk and how that translates into credit implications is another. And that's where this standard absolutely comes into its own, because the two have to go hand in hand. Now, even if we don't have mandated transition plans in the UK or elsewhere across the globe, that recognition that these two things go hand in hand is really important, because you can only manage the risk effectively if you can transition, if you can mitigate the risk that's been identified. So that would be the build that I would wholeheartedly agree with everything that Manveer mentioned. But the other thing that I would just want to raise is that as we start to mature how to understand strategy and build transition plans and where the opportunity in transition might be across different sectors, you know, thinking about sector related transitions and the guidance around that, there is inevitably a pull in the market. And Manveer, you mentioned this is all about implementing change across the real economy. Now, the real economy are broadly small and mid-sized businesses. Now, a lot of the work that we did at Bankers for Net Zero, and is still something that I'm pushing in my advisory capacity, is what does fair, reasonable and proportionate data requests and engagement with small and mid-sized businesses look like? Because what we can't have is the biggest organizations in our marketplace absolutely recognizing what good transition looks like. And good transition means understanding the risks and finding ways to present the opportunity to those organizations that sit as part of your portfolios to encourage them to transition, to be able to find the opportunities to deploy finance. Now, that means engaging with those businesses in a different way. It is not just about compliance. It is not just about reporting and disclosure. It is about putting in front of them the unique, the bespoke opportunities for transition for their organization. Now, the gap we have for most big organizations at the moment is they don't understand their supply chain and the businesses within their supply chain, or for banks and their portfolios, the organizations that sit as part of their portfolios in enough detail to be able to make those opportunities resonate. Now, what we did at Bankers for Net Zero was say, well, recognizing the global momentum in transition and understanding risk, and all of that is absolutely right. How do we put in place the guardrails that minimizes burden that the real economy will face as a result of essentially increased outreach into that real economy marketplace? So, you know, we've got to, you know, it's almost like we cross one bridge and then we've got to cross the next, and that's the next Rubicon we have to cross.
Super helpful, super helpful. I think what we've heard actually during the process of developing this standard is that it may ultimately need to be supported by some additional implementation guidance. It sounds as though that's one area where some future implementation guidance could be valuable. Are there others in your mind?
Well, the work that we have done, and you know, all of this is for refinement, is, and a personal view perhaps for this webinar, I don't necessarily think that SMEs, especially the smaller end of SME, so the small and mid-sized businesses that make up the majority of SMEs, should be responsible for building their own transition plans. I think that's wasted effort because, one, would we trust it? Is it just ChatGPT generated? And two, how can we actually track that they are delivering on said transition plan? I think that is where the role of the big banks comes in. That's where the opportunity to finance and build out those opportunities for change really come into their own. But what is important is the core understanding of a business, where they're based, so their location, their asset, and of course their energy profiles. What energy are they using, both electricity, gas, and maybe understanding some of their main scope 3. But if we can find a way to streamline the guidance around the emissions reporting, even in the first instance. So we've been working as part of another ISO stream, ISO 14060, which is focused on the methodology for greenhouse gas reporting. And in that specifically, there will be an SME annex, which is focused on the guidance around what is reasonable, fair and proportionate, and how do you ask SMEs these questions? Because actually, is it fair to ask them for a fully fledged transition plan in the same way that we're asking big organizations? My assertion is no. But is it reasonable to understand their location, where they're based, how they operate, their energy demand? If you are a financer of those organizations, my assertion is yes.
Brilliant, brilliant. I think that really goes back to the enabling role of financial institutions that we were talking about here, and it's a real underpinning of this standard. Thank
Absolutely.
you so much for that. Some great perspectives there. Let me bring Carsten in. So Carsten, again, thanks so much for joining us. You've got a lot of experience in the sustainable finance landscape, especially in the EU. So what's your perspective on the maturity of transition planning among financial institutions in the EU region? And how do you see this standard fitting with the evolving regulatory and practice environment for transition planning and transition finance in the EU?
Well, actually, Mark, I think this standard fills in the gap which we have in the overboarding EU regulation around sustainability. Because, well, as Hannah already indicated, transition plans are not mandatory, but if they are addressed and they are communicated to the public, they must be verified and by a third party according to another regulation, which is the EMCO Empowering the Consumer Regulation, which takes effect in September this year in the European Union. Transition overall is a very key element of the Green Deal, which was initially announced in 2021. Since then, of course, the geopolitical situation changed and priorities changed. I was part of the group which developed the CSRD, the Corporate Sustainability Reporting Directive, and following that, the European Sustainability Reporting Standards. We try to give a holistic picture of sustainability efforts and objectives of the reporting entities to any stakeholders. But this was considered as being too burdensome by a lot of smaller entities, and therefore there was this omnibus initiative by the European Commission to scale down the scope. But this, of course, brings, as Hannah already indicated, a lot of problems to the financial institutions because they do not get the information anymore from the regulatory reporting line, but it drives them back again to send out questionnaires in order to get the necessary information. However, the financing industry is meant to be the key part of the Green Deal and to gather on average 260 billion euros per year in the next 10 years in order to get our economy to the path of net zero. We haven't been there yet. And I think the recent heat wave, which we experienced, at least here in parts of Europe showed that the topic is again not only limited to what can I do in order to avoid climate change, but in order to make risk assessment of climate change. When infrastructures fail, motorways were closed in Germany, for instance, rail tracks were affected, hospitals were malfunctioning. So you can ask yourself about the resilience of your supply chain. And the transition plan, as we drafted it in the ISO framework, is really giving you a structure in order how to assess this and how to report this. And I think this really fills in the gap on the operational level, which we need in order to fulfill the requirements also of the European Sustainability Reporting Standards when you report to it. But it not only those, it's compliant also with the ISSB S2 standards. And going further, a credible transition plan actually gives you the possibility to qualify also as a transition financing asset. Because we have another regulation in the European Union, which is called the Sustainable Financial Disclosure Requirements, SFDR, which is about to be revised and into 3 categories. And one of the categories is transition financing. And a credible transition plan actually gives you the basis to be in this kind of bucket. So I think ISO is really giving a helpful standard here to make it more structured, what has been reported so far, because it's not very harmonized what we've seen currently in the first reports. But this structure can be given and gives also a clear indication of where risk reporting can go to actually. And I think this is really helpful. But again, we are still at the beginning, of course.
Amazing. Thank you very much indeed, Carsten. I mean, just given all of that, how do you see EU financial institutions beginning to engage with the standard? Do you expect good engagement across the region?
Yeah, well, this is driven, as I indicated, mainly by another directive, which is the MCO directive. So for legal requirements, if financial institutions want to communicate to all stakeholders and on the web page that they will become net zero, they have to prove it. And they can prove it with this, but by applying the standard and getting it certified. So this is right, and there's already demand.
Thank you. And we had a question come in during the registration process for this webinar, and that question asked about the link between this standard and existing ECB and EBA regulations. I wonder if you could give a little bit of a sense of how this standard would sit alongside the banking regulatory framework.
Yeah, the weakness of the European Union is that we've got a lot of authorities who have their own ideas of what you have to report as a financial institution. And so I hope that this ISO standards gives also the same as for the accounting purposes, a structure for the risk reporting. We have overlapping requirements, mainly based on risk reporting, I have to admit, from the ECB, but also from the European Banking Authority, to assess this risk when a loan is handed out. The European Central Bank, starting tomorrow, asked for sustainability assessment of a refinanced corporate bond portfolio. But also for the risk reporting in the insurance world, what we call the author reporting to the regulators. a lot of emphasis is given on the exposure to climate change. For insurance, of course, they always first think about insured risks, because they fear that some risks are not insurable anymore, that they have taken on board too many risks. But I see also a lot of influence on the investment side, which is for me is a bigger portfolio even for the insurers, but this is with life insurance. I think this ISO standard can give the opportunity to harmonize this kind of risk reporting, and hopefully, as we've already tried to do it also in the ESRS framework, to make a matching between ISO standards and the reporting requirements. Basically as an application guidance, as you would call it in the accounting world. And I would like to invite the different stakeholders in order to push for that. I, for myself, will do it because for a user, because I'm reading these reports. It is easier if there's the same structure and to make it more comparable. Not only for users like me as a human being, also for new tools such as artificial intelligence.
Amazing. Thank you very much. Well, this has really kicked us off very nicely, and it's prompted quite a lot of questions already from the audience. I might just turn to a few of those now and bring various of you in, depending on the question. I mean, I think a couple of questions, perhaps Paul in the first instance, and it follows a little bit what Carsten was just saying. So one question, I'll call out three because they're sort of quite related. So the first one relates to how this standard sits against wider corporate reporting, capital reporting by banks under Basel. And I think Carsten's already given a little bit of a European flavour on that. I don't know if you've got any points you'd like to add there. There's also a question around whether an institution could simultaneously apply the TPT disclosure framework and this ISO standard. And I think you alluded to that complementarity in your early remarks, but you may want to say one or two more words on that. And then there's another question has come in. So far, a lot of the focus has been on lenders, banks, and financing. How about for insurance? Yeah, you might want to say a few words about that, given your insurance background. So maybe we'll start with those, and then I'll bring other colleagues in for the next round of questions from the floor. Thank you.
Yeah, thanks very much, Mark. Yeah, I mean, I think the Basel framework and the capital implications around this are interesting anyway, but also interesting in respect to the standard. For those listening, I'm sure quite a few people are familiar with the frameworks, but essentially there are three pillars in there. The first one is about quantifying capital requirements. The second one is about the supervisory, the governance processes, and the third one is about disclosure. So really where I would see the standard as being most relevant is certainly around the second pillar, which is the governance thing. So this is the ORSA and the ICAPs that Carsten mentioned. And I think, again, you know, we've been looking at the sort of guidance that's been appearing from regulators, from central banks and from the FSB itself. And I think that the components within the standard that actually look at identifying the current situation of the organization and that forward-looking element about the the financial related risks and opportunities. Risks probably is more focused from a regulator's perspective. So it should align with that. It doesn't compel anything in relation to capital, quantitative capital requirements. But I think the way it's going in the regulatory environment is, along with the broader recognition that we're all seeing, that we're actually seeing currently material financial risks associated, particularly with physical climate-related risk. So yes, it could support that process in the sense of, if in the capital adequacy, it feeds into the sort of 1 to 3 year process around that. It could feed into that, but I think primarily it is about the pillar 2 and aligning with the kind of approaches that have been taken by regulators to look at climate related risks, like the requirement for a scenario analysis, for instance, would fall into that category. And I think TPT, we already mentioned the similarity of the diagram, and I think there is a lot of consistency between the two. I think we've had the luxury of working using the existing TPT framework, and in some elements, perhaps there are additional elements that we put in there. For example, there's a greater emphasis around adaptation, for instance, in our standard. But the other thing to say, and I think I mentioned this at the start, is that the framework is essentially a consolidation of material that's already out there. So there is reference to TPT, and if somebody was looking at a way of assessing portfolios, there are a number of ways that you could do that, and we don't specify that you need to use a particular one, but we would try and signpost some of the existing mechanisms that are already out there. So I see a lot of consistency, certainly with TPT. And finally, thank you for the person who asked the insurance question. I do feel like, and again, I worked a long time in insurance, so I feel it sometimes get a bit forgotten. But yes, for sure, that came up very early in the process, that we wanted to have a standard that was capable of being applied right across the financial sector. Clearly, there are different considerations between an asset manager and a bank and an insurer, but actually, it's trying to get that common, credible framework, those framework elements in place to support transition planning. So I think for an insurer, for example, the processes, the underwriting processes, for instance, rely on quite detailed location knowledge, for instance. Now, I'm sort of, if I had a wish list, it would be the kind of experience that the insurers had over looking at location dependent physical risks and wider risks could feed into this whole process. And the robust risk management processes, the credit risk processes from the banking, again, could inform practices more widely. And I think, again, look at asset management, the sort of engagement processes that they have, again, could benefit the whole of the sector. So maybe I'm being a little bit too optimistic, but I think there are things that the different subsectors of finance could learn from others, and hopefully our standard might go a little way towards promoting those.
Brilliant stuff. Thank you very much. I might bring you in here, Manveer, because I think there are a couple of points there that it'd be good to get your perspective on. Paul mentioned the integration of adaptation considerations in the standard, and that was something that got a lot of support very, very early on in the process. And I know CDP's been giving some thought to that as well, and looking at integrated transition planning. So I'd love to get your perspective on that, but you may also want to pick up on other points that Paul made.
Yeah, thanks, Mark. Of course, when the word disclosure comes up, you can't help but get CDP putting their hand up. So what I will say is on adaptation, this is where the work of TPD to lay the groundwork has been so essential, because it's given us the base architecture with which the Climate Financial Risk Forum here in the UK, convened by the Financial Conduct Authority, the Prudential Regulator as well, has been able to surface a bit more color around what it takes to have adaptation integrated within transition planning. And so I think it speaks to that point that because of this interoperability with the TPT disclosure framework and the ISO standard, as the CFRF has come out with this guidance, and on the insurance side, as the UN convened Forum for Insurance Transition has actually also provided a lot more detail around what transition planning looks like from an underwriting perspective, both from an implementation and a disclosure side. I think that, and I should say just on the latter, that also builds on the TPT framework. And so I think we have this nice common base that cuts across all of them there. I think more practically, what we've been doing for the CDP questionnaire is taking a look at all of these different pieces of guidance that have emerged. I think UNEP FI in particular and the principles for responsible banking have developed a lot there. And we've tried to understand what will that mean for the financial sector and for the questionnaire. So certainly that's a live conversation for us as we evolve the question bank and continue to try and support those financial institutions that want to get ahead in their disclosures.
Brilliant. Thank you very much indeed. Hannah, I wonder if I can bring you in on a couple of other questions. There's a really interesting one here which you might have a perspective on. So it's a participant from Colombia who works for a public financial institution, and about 85% of their beneficiaries come from low-income backgrounds, and their mission is to transform lives through education. Given this context, it's clear that our primary focus is social rather than environmental. What do you believe should be the right approach for an institution like this in the transition towards net zero emissions? And just really interested in your perspective on how social considerations can be integrated into that transition planning process. It's obviously something that we allude to in a few places within ISO 32212. Yeah, any perspectives you have on that social dimension would be fantastic.
Yeah, of course. I mean, the obvious response is yes, of course, social dimensions have to be included. That's a cop-out on my part. I think the way that I would answer it with a bit more depth is the work that we've been doing focused on small and mid-sized business transition is grounded in community and social equality, because if we're not looking after and transitioning and building resilience in SME communities and ensuring that finance reaches those organizations, we are ultimately impacting communities because there's less jobs. And how can we build resilient and finance communities unless there are the SMEs in them, which are the lifeblood of those communities? So we see managing the risk of transition, SMEs, and the allocation of capital for transition to SMEs, and social equality as one and the same thing. But absolutely, the recognition needs to be part of, and for any bank, especially the banks that I'm working with in the UK, building and recognizing community value is such a core part of their strategy now, that it's being fed down, toned from the top through to portfolio management. And I think one of the brilliant things that I've seen over the last 18 months, certainly in my engagement, is this recognition of I'm not going to do anything vis-a-vis sending out data requests, sending out questionnaires to my portfolio customers, whether they are individual consumers or SMEs, unless I can demonstrate value, unless I can demonstrate to my customers that there is a benefit for them to doing this. And that in and of itself is recognizing, well, actually, how do we flip this from a benefit to our customers? And there's a social element in that, of course.
This is amazing, and it links into one of the other questions that has come through as well, which is how does this standard impact non-financial organisations? And you talked quite a lot about that in your previous remarks as well. You know, the flow through in terms of information requests and scrutiny and engagement. Ultimately, this standard is firmly directed at the financial institutions, but as we've recognised and as came through very clearly in Manveer's stats, this is all enacted through the real economy companies that make up the clients and the investees of the financial institutions. And so how the financial institution engages with those is ultimately going to be a really important way in which this plays out.
And I'm working with banks that are absolutely choosing to double down on the societal impact lens of this rather than necessarily the climate lens. And that is focused on the amount of lending that they are deploying into lower economic regions. It is recognising social vulnerabilities and how lending and job creation in those areas is supported by their lending. And that is absolutely the role that financial institutions play. It is a growth lever, it is a social equality builder. And how can we make sure that the financing opportunity is getting to the right places for those opportunities to be felt equally across regions? And, you know, there are organisations that are absolutely taking that lens, and I commend that.
Brilliant. Manveer, Carsten, did you want to add anything on that?
I might just come in briefly on the point of adaptation linked to social, because I think that this fundamentally, I think the mitigation challenge has been considered certainly for the past few years at this macro global level. And I know we're getting specific now on sector basis, but when we drill down into what some of this guidance around adaptation portfolio level looks like, you can't shy away from community engagement, from the implementation of do no significant harm, but actually going beyond that to think, well, what does it mean for a project to really support a community in adapting? And so I think that the work that this ISO standard does to ensure that adaptation is considered at the heart of any net zero considerations is critical to start to think more holistically about the end communities that are affected by any finance.
Yeah, so it's important to say that this standard is called transition planning and not exclusion policies. Because what we experience currently is a practical example of a different firm. We own forests here in Germany, and in the biggest heat wave last week, our insurer told us that we are not insured against wood fire anymore. Instead of helping us to find measures in order to protect the woods so that they do not inflame, they just cancel the coverage. And the same would apply to banks who just would stop lending to companies very much exposed instead of helping them in order to make the business more and more resilient. And I think our ISO standard 32212 gives some ideas here how you should engage with the client, because I think it's nearly 99% is scope 3 category 15. So it means it's not the own operation. I do not care whether the bank or the insurance company loses less paper in their daily work. But what I care about is that they still give insurance coverage in order to help the economy, to help companies to adapt, in the same way as banks, they still provide financing for it.
Thank you very much indeed. That whole real economy impact and the potential counterproductivity of a laser focus on financed emissions is an important observation in the standard, very much consistent with the transition plan task force work as well. I am going to try and close out the panel with just one sort of quick fire question to each of you. We've been through a lot of the questions that have come through from the audience. There's one or two that perhaps Dan will be able to pick up in his closing remarks. But for the quickfire question, so could each of you give it your perspective on what's still missing in the enabling environment for sustainable finance, and what role can the international standard system play in terms of filling remaining gaps? Perhaps I can start with you, Hannah.
Yeah, mine's pretty on brand. Mine is, what is the guidance around data collection that is fair, reasonable and proportionate from small and mid-sized businesses? Because the more we plan for a transition, the more we need to engage with the real economy.
Wonderful. Nice quick one as well. Thank you very much, Hannah. Brilliant. And thanks so much for your contributions to the panel. Manvir.
I think this was a webinar on its own, but I think really enabling environments, right? We hear a lot about the importance of actually having the right fiscal and monetary incentives, the real economy conditions and infrastructure that will enable us to transition. And those broader dependencies will be absolutely critical to address if we want these standards to really be elevated and utilized to scale transition finance. So I think the role of standards here is to be the connective tissue. So once we've got that policy ambition and we can call for that with the more comparable real world data, we will be at a better place to see this happen in practice.
Brilliant. Thank you very much. And as you know, that was a massive focus during London Climate Action Week last week. It seems every room I sat in, there was a big debate around the policy environment and the wider enabling conditions. And as Paul described earlier on in his overview of the standard, that system perspective was very live and very central during the development of this standard as well. Carsten, could I get your perspective on what's missing and
yeah, what's missing? I mean, it has to be applied now, and then I would like to measure the performance of applying it. So the ESG performance, basically, that's missing, and in order to assess and identify the good and the bad guys. That's because I think it's going to become part of a stock valuation also. How good you're on transition planning, whether you can be picked as a stock in a global portfolio or not. There's another initiative at ISO going on to define a framework for ESG value, or sustainability value, as we call it. And I'm eager to see what's going to come out of it.
Brilliant. Thank you so much. Look, you've all been absolutely marvelous, and thanks very much for staying on, Paul, to answer a few questions there as well. Brilliant. Just remains for me to say a massive thank you, and we look forward to continuing to work with you as this goes through into implementation. And thank you all for your contributions along the way as the standard was developed as well. So I am going to pass back to Dan. I should say, Dan, there was another one of the questions that came through from the floor, which you might want to pick up in your closing remarks, was the following. Many financial institutions may not yet recognise the value of international standards for structured and verifiable transition planning. Are pilot applications with financial institutions planned to demonstrate the credibility and practical benefits of the standard? So a nice strategic question, which I hope is a good segue to your closing remarks. Yeah, thank you everyone for your attention. Thank you.
Thank you very much. Thank you, Mark, Paul, and particularly thank you, panel, for your generous insights, and thank you, all participants, for your questions. I'm not going to try to summarize this, but let me sort of bring this to a close with a few practical thoughts on where this goes from here, because as the launch is obviously just the starting line. So, building on that question around piloting, as if we have planned for it. Can I have the next slide? So what are next steps? So I suggest, I'm unable to see who is exactly participating in this webinar, but I suspect that there are basically sort of two groups of people and participants. I think there will be a group, or there is a group that is already be doing transition planning. You probably have policies and processes and arrangements already in place, and some of you will be really advanced. For you, the standard is not about starting over. It's a way to benchmark and to refine what you've already done against an internationally agreed view of good practice. And if that's useful to you, to obtain independent certification that demonstrates the credibility of your approach. So if you're already in transition planning, the standard can be helpful to obtain that certification. Now, for a lot of other organizations, transition planning may still feel quite new. And in that case, the standard is designed to help you to get started, to give you a clear and structured place to begin. So either way, I really genuinely encourage you to engage with us. We as the BSI team are very keen not only to support organizations in applying the standard, but also to find and to showcase good examples of it in practice. And so back to the pilot question or the early adopter question, we have developed a very low commitment way in, sort of alignment review, a gap analysis, basically a structured look at where your current practice already meets the standard and where there are gaps. And we can do that with support from this team. There is zero obligation in this. It's simply a very sensible first step. And I'm going to say the link on the screen, but I'm not sure if we're that advanced. Yes, there is. Sorry, thank you. There is the link on in the chat. So the link in the chat will take you to our Transition Planning Hub, where you can find further resources and where you can find information on early adoption. I will also, on the last slide, there is my email address, and I would be delighted to start a conversation with you and here with our team. So please do get in touch with me if you have any questions on piloting or anything that we can help. And then I just want to mention two other things, and that's the next slide. I think that's also a broader invitation that I'd like to extend beyond this one standard. So we've been talking a lot about national standards bodies and about ISO, and everything that I described earlier, the consensus, the bringing of experts around the table, that really only works if the right people take part. And that includes people like you, people in this audience. So in general, there are a few ways in. You can become a standards maker yourself by joining one of the committees. You can comment on the standard that is out for public consultation, or if you spot a gap somewhere, you can propose an entirely new standard. Now, if you're based in the UK, you can do that through us. And again, you can get in touch with me. If you're based outside the UK, I strongly encourage you to get in touch with your own national standards body. And there is an ISO webpage that holds all national standards bodies, all 177, and all their contact details. Again, if that doesn't work, please do get in touch with me. And then nearly final. Hold on, something. Sorry, that gives me a minute. Sorry, nearly final. Particularly if you're sort of early in your career, or if you work alongside people who are. We also run a young professionals network for those who are somewhere between 80 and 35. So it's a way to develop your career, to build connections across industries and across borders, and help you to play a part in shaping a real better future through standards. It's a fantastic community, and it's a really easy one to join. So if that's you, or if it's someone in your team, I would encourage you to scan the QR code on the screen, or to get in touch with my colleague Sarah, and her email is up here. So please do pass that on as well. And that brings us to the end. So I want to thank you, first of all, for giving us your time this afternoon. I know it's a busy moment in everyone's calendar. I want to thank Mark and Paul and to our excellent panel for sharing their expertise. And I really like to leave you with the thought that we started on. Commitment across the financial sector has never really been in short supply. What's been harder is the execution, turning all that intent into something consistent, something credible, and something built to last. And that is what ISO 32212 is designed to help you with. And that's why I'm personally very pleased to see it being published now. But the standard only works if institutions will start using it. And I really, really hope that that includes many of you. So my details are here on the screen. You've seen the links that we've shared in the chat. Please do not hesitate to get in touch, whether you like to explore becoming an early adopter or just whether you want to simply continue the conversation. So with that, I'm going to give you 5 minutes back of your time, and I want to thank you all once again, and I wish you a great rest of the day. Thank you.